Have you ever wondered how financial advisors really get paid or how much money they really make? Have you noticed the lack of transparency when it comes to how financial advisors get paid or how they almost don't want to talk about it? Well, we're going to expose all of that for you. Just give me a minute. I've been a financial advisor and fiduciary for over 25 years. And in that amount of time, I have worked as a broker, I've worked as a fiduciary, I've worked in insurance sales, I've done just about all of it. And even the things that I haven't done, I understand exactly how they work. It just comes from 25 years of experience. But one of the things that frustrates me is the lack of transparency. Most people have an idea of what they're paying their advisor, but most people don't know everything that their advisor is getting paid, or they also don't know everything that goes into the expenses of a portfolio. So let's break down the different types of financial advisors and the different ways financial advisors get paid. So let's start with what's called a fee-only financial advisor. Now, this is advertised quite a bit. It sounds pretty good if you understand the detail, but what does fee only really mean, right? You're only paying a fee to the financial advisor. And the way that it should work is the advisor charges you for advice, but they don't charge you to manage the portfolio. So this will often show up in an arrangement that you would have with an advisor where you might meet with them once a year, and they might put together a portfolio for you, maybe a financial plan, and they'll just charge you for that plan. Oftentimes, I'd say the average is maybe about $1,500. So let's say you go, you meet with them for their time, they put together the financial plan, they make some investment recommendations, and you write them a check for $1,500. Okay, see you later, then come back in a year. But that's the only thing that you pay. Now, many people prefer that type of a relationship because you know exactly what it costs you. It's a flat fee up front. So what does fee only look like to the individual that has fee only? We've already said you might go pay somebody $1,500 to write up a financial plan and give you a recommended portfolio. So let's say I go in and I say, listen, here's what I'm looking to retire, or this is how much income I want. I look at myself as a moderate investor. What should I do? That might be something I would say to a fee-only advisor. Now, they're the experts, so they go back, they do the math, they do a written financial plan, shows you things like income, where it comes from, taxes, inflation, all of that. But then also, they should break down a portfolio for you. So here is the recommended portfolio. So if I was going to do a fee-only plan, I would probably go through and just help somebody choose allocations. I might go to a company like Vanguard and I might say, all right, well, great company, lots of diversification, low cost, diversified investments. And so I might build out a portfolio for someone at Vanguard as a fee-only advisor and then make that recommendation. Now, it will be up to them to go implement it on their own. They're going to take the plan and the recommendations, implement it on their own. And as a fee-only advisor, if I was doing that, they would write me a check. So let's say, again, I'm charging $1,500. Mike Lester, $1,500. Here you go. They go on their way. Now, that works great for some people. Doesn't work for everybody. Not everybody wants to go out and have to implement it on their own or keep track of it on their own or over a year's time try to figure out when to be in something or when to be out of something. Now, the next version of that would be what's called fee-based financial advisory. Now, a fee-based advisor could still be fee-only. They might just charge you as a fee-only advisor a fee to put together a portfolio for you. But what they could also do is charge you a fee to manage a portfolio. This usually shows up as a management fee. It's usually a percentage on an annual basis. I'd say the average fee that somebody might pay would be around 1%. Now, that's an average. So if you have less money invested, then you probably pay a little bit more. If you have more money invested, you probably pay a little bit less. But industry-wide, I'd say the fee to manage a portfolio probably averages somewhere between 0.5% and 1.5%, and 1% is obviously in the middle. So in other words, if you had $1 million invested with an advisor that was charging a 1% fee and you were paying that annually, you'd be paying $10,000 per year or 1% of $1 million. Now, if your portfolio grew, let's say they helped you grow it from $1 million to $2 million. I'm doing simple math here, I realize. But if they did that, they would then be gaining 1% on $2 million or $20,000 a year. And you have to ask yourself, do you like that type of relationship? Your advisor is making twice as much money, but now you have twice as much in your portfolio. And if that's the type of a relationship you're looking for, you might be interested in a fee-based relationship because the advisor has a vested interest in you doing well. The better you do, the better they do. The worse you do, the worse they do. In other words, if you had $1 million invested with them and they were getting 1% of that, they're getting $10,000 a year. If they did a terrible job and your portfolio went to $500,000, they're now getting 1% of $500,000 or $5,000 a year. Neither one of you want that. Both of you would like to see the portfolio grow and both of you benefit. So that's how the fee-based relationship should work for most individuals. And I would say if it's not working that way for you and you don't find that your advisor is helping you get higher rates of return net of their fee and or reducing risk over time, it's probably not a great relationship and you might want to shop around. Now, another relationship that you could have would be a brokerage relationship with a financial advisor. Now, brokerage means they're earning a commission to trade your account. Think of Wall Street back in the 80s or stockbrokers where they literally got paid to buy and sell positions. That would be a brokerage relationship. Or a brokerage relationship could be one where they propose a mutual fund. And when you buy that mutual fund from that advisor or broker, they're getting paid a commission or a fee from the mutual fund company. They have other products, things like annuities or real estate investment trusts, but if you have a relationship with a broker, you'll notice because you have a statement from their broker dealer or firm, you'll see mutual funds or other products in there. They're not charging you a fee to manage it, but they're getting paid a commission or fee from the companies that you're invested in. And the last type of advisor you might be working with would be something I would call a hybrid advisor or simply an insurance advisor. Kind of a new term. People like to use the word hybrid because it just sounds good now, sounds nice and green. But the hybrid advisors are typically promoting annuity products in my experience. So they'll sort of set themselves up as, well, I'm a fiduciary, I help people manage money. But in the conversation, you might find out that they're actually promoting annuity products. And the hybrid part of that would be, well, a portion of your money may go into a managed account, but another portion of your money would go into an annuity account. Now, these advisors are pretty common these days. You'll find them, but just realize that there are certain things you want to look out for there as well. First of all, why are they setting themselves up or promoting themselves as a fiduciary? Fiduciaries, by law, are supposed to put your needs ahead of their own. In other words, you benefit before they do. So if somebody's claiming to be a fiduciary and then they try to work a product that they get a commission into the conversation or into your financial plan, they've literally taken the fiduciary hat off and put on an insurance salesperson hat to generate a commission. So ask yourself that question, because they are going to benefit from the annuity through a commission. Now, another thing that I've seen in this hybrid relationship is a sales process where they're insinuating that by putting you in the annuity, they're reducing your fee. I've seen the situation where you have an advisor, and let's say it's a fee-based advisor that does not sell annuity products versus a hybrid advisor that's doing fee-based plus annuities. The hybrid advisor will suggest that their fees are lower. Now, their fees aren't actually lower. Let's say they're still charging you 1% on what they manage, but they will insinuate that because your money went into the annuity and they're not charging you a fee on that, you're somehow paying less. Think of it this way. If you had $1 million to invest with a fee-based financial advisor and they were charging you 1% per year, you'd be paying that advisor $10,000 per year to manage the portfolio. Let's say a hybrid advisor says, well, move your money over here. We're going to put half of your money in a fee-based account, charging you 1%. So 1% on $500,000 is $5,000 per year. And then we're going to put the other $500,000 or $500,000 in an annuity. And they suggest that somehow you're not paying fees on the annuity. And the sales process is, well, look, I cut your fees in half. You're going to pay the advisor that's charging you 1% $10,000 per year on $1 million. And you're going to pay me $5,000 per year on $1 million because I put half of it in an annuity. Ask yourself, why would they do that? Why shoot yourself in the foot as a financial advisor and only charge $5,000 when you could be charging $10,000? Well, it's because they get a big commission, usually 7 or 8% on the annuity that they're putting you in. So they're front loading their commissions on the annuity instead of taking a fee over time. The other issue with that is they're not disclosing the fees a lot of times that you're going to pay on that annuity, in particular fixed indexed annuities, and those fees or expenses are much higher than 1% if somebody took the time to explain it to you. So several different types of financial advisors out there. I hope this has been helpful. As you're looking for a financial advisor, make sure that you understand the differences between them and get all of the information that you need to make informed decisions. Thank you for watching. Go to guardingyournestegg.com for your free and objective personal financial plan.